All right, for those that are joining us now, see we've got a couple of extras. We've got some webinar disclaimers up right now, but I'm also going to bring up the webinars page so you can sign up for future webinars. If you go to optionhotline.com/webinars, you'll find all of our future webinars that are currently scheduled. So current one right now that you're on, the October Options Marketplace, that's our featured webinar with Don Fishback. We've got all of our replays from any previous webinar, a couple with me, Keith Harwood, as well as Dr. Duke. You can see Dan Passarelli, Steve Kalasian. So we've got a number of really good free educational pieces of information here. Please do take advantage of this. They're all free. They're all still available from our historical webinar presentations. Today, again, we've got Don Fishback here talking about the options marketplace. He's going to do a little bit different from what we've put here into the description, as he mentioned to me earlier today, but that's fine. We're going to talk about how to make money in the markets, and that's just as good as anything else. And then again, keep an eye here. If you have to leave early, we'll have a replay posted here this week, and we'll post the next upcoming webinar starting tomorrow. So this is a great resource for you to get free educational webinars, and we're going to get started here in about 1 minute. So we'll see how this goes. All right, it is 4:30 Eastern, 3:30 Central, and we are going to get started here with Don Fishback. First, I am going to post some disclaimers from Option Hotline that I urge you all to look over before we get started. So let's bring those up now. Take a moment to read through these, and then I will hand the reins over to Don. All right, Don, are you ready to take over?
I think so.
All right, it's all yours when you're ready.
Okay. Let's see here.
And for those of you that have joined us, if you have questions throughout the presentation, feel free to post in either the chat box or the Q&A. And if I happen to get them over to Don during the presentation, that'll be great. If not, we'll definitely answer them at the end of the presentation. So
okay,
do not be afraid to put them there. Yeah, it is.
Yeah, I thought I wasn't expecting you. I was expecting Steve.
Yeah, no, I decided that I was going to go ahead and chat with you again today. So thanks for joining us again, Don.
This is an unexpected perk.
Yeah, exactly.
That's awesome. Yeah, all right.
All right, Don, man. I'll let you take it away. And then again, if you have any questions as you go through, guys, please throw them in the chat or the Q&A box. Thanks again.
Okay. Hey, everybody. And I am Don Fishback. And today I'm going to talk about how we profit from mispriced odds and how you can too. And for those of you who don't know me, I'm a 37-year vet. 37 years is hard to believe it. 37-year veteran of the options and technology field. My company, we've been around for over 28 years now with a tradition of excellence. I am the author of Options for Beginners. It's a book that I wrote where actually all the money raised from that, all the profits raised from that went to the American Heart Association. And fortunately, it's been read by 100,000 investors, which means we've given a lot of money to the Heart Association. My specialty is market probability and option pricing, and I'm a recognized expert in that field. Here's some of the places where I've been featured, and even in the New England Journal of Medicine, where they cited me as an expert in probability and analytics. So I'm the creator of the pioneering options analytics based on probability, options and derivatives decision support, otherwise known as odds. And that's basically our methodology is the odds. So in terms of give you some background, the early developments in probability, you'll find that I didn't invent any of this stuff, this early stuff. I didn't invent the bell curve. I just introduced it to the general public. And shortly after launching my own startup back in 1993, I produced this video in cooperation with Futures Magazine. And it was the original odds video way back again back in the early 90s. And in that video, I basically took the Black-Scholes option formula, which this is the Black-Scholes option pricing formula. I took that and I showed how you could extract probability from it, and you could extract from it a probability calculation. And this is a software program that I created back in the summer of 1993. So this is the Windows version, and I was able to actually do a screen capture of the Windows version. The first version was actually in DOS, if you remember that far back. And I couldn't get a screen capture of that thing. They didn't have it back then. But then came Windows. And so was the first program widely available to individual investors that calculated probability using the assumptions embedded in the Black-Scholes option pricing model. And while that wasn't unique, the next step was to take that bell curve and reverse it, just take the bell curve backwards. So instead of calculating the probability of hitting a target, where that's what we did before, where we took a stock price and then a target price, and we figured out what the probability of reaching that target price was, we reversed it and we calculated a target based on a desired probability. And from that, you have this indicator that I created called the odds probability cone back in 1996. And 23 years ago, back in 1998, this indicator became a part of Thomson Reuters Metastock. So Thomson Reuters owned Metastock for a time, and it was put into their program. Metastock's, they're actually on an independent company right now, but back then it was part of Thomson Reuters. Anyway, these two tools are now part of nearly every options brokerage platform in the United States. This is Schwab, and there's your bell curve. And this is Tastyworks, and you can see in that orange box up near the top, there's the bell curve there. And then here is Cboe has a program called LiveVol. Well, there's the bell curve there. But then that probability cone, well, there it is in TD Ameritrade's Thinkorswim, and here it is in E-Trade, and here it is in Fidelity. So all these things have been widely adopted. Again, I didn't invent this stuff, but I'm the one that made it popular back in the mid and late 90s. So these, and by the way, these are just a few. There's plenty of others. I just didn't want to take up all your time showing you all the others. But what it gives you an idea is that there's something special about probability. I mean, everybody feels like they need to have it. So what is it? What is it that makes probability so special? Why does every trading platform consider it? It's basically a requirement now. Why does every trading platform consider it a requirement to have probability analysis? Well, as we'll demonstrate shortly, probability determines risk and reward. So for options trades, risk and reward are based on the price, for example. And since most of the people watching this, I'm going to assume that you're traders, so I'm going to assume a little bit about how you know how an option works. So this is a call option, and let's say a stock is at 50 and the 50 call costs $1. Well, you buy it and the stock goes up to 55. Well, that call is now worth 5. Well, then you sell it. Well, your risk was the $1 or $100, and your profit is $400, right? So that's one example. In this particular instance, now the stock is at 50, but the 50 call costs 2. So you buy it, the stock goes up to 55, you sell your call, the call is now worth 5, and so you sell it. Well, in that instance, your risk was $200 and your profit is $300. So your risk went up and your profit went down. And the higher price meant higher risk and lower reward. So this relationship shows that risk and reward are determined by the price. Therefore, if price is risk and reward and probability determines risk and reward, then probability determines the price. That's what we know. So a corollary to that is if the probability estimate is correct, then the option price is correct. If, however, the probability estimate is wrong, then the option price is also wrong. The implication of that is, whether you realize it or not, every option trade is a probability bet. Every single trade is a probability bet. So a mispriced option is the result of inaccurate probability expectations. So option mispricing, that's where we make our money. Option mispricing is the source of our performance. And that's where we're going to finish. But first, we must begin. So you can exploit mispricing to become a better options trader. So probability determines risk and reward. So by observing probability, we can determine risk and reward, whether it's an option trade or, for that matter, any other speculation. To demonstrate how probability determines risk and reward, we're going to begin by observing a very simple game of chance. Now, it's important to remember, in any game of chance, no player wants to give the other person an edge. So we're going to assume that both the gambler and the, let's say it's a casino, we're going to assume that no player is willing to concede an advantage to someone else. Well, here are the details of the game. Real simple game, a very simple lottery. There are 100 unique tickets for sale. Each ticket costs $2. That's the risk. The winning ticket receives a $100 jackpot. So that's your reward. The lottery, remember, there's 100 tickets, $2. So the lottery collects $200, but the jackpot's only 100. So they only pay out $100. Well, that's not a fair game. The ticket buyers collectively lose $100. So given a 1% likelihood of winning, and that's what it's 1% because it's one winning ticket out of 100 sold, given a 1% likelihood of winning and a $100 payout, the tickets are mispriced at $2. The ticket seller has an advantage. That is not a fair game. What would make the game fair? Well, the game is fair when the amount collected equals the amount paid. So let's revisit the game. We're going to keep the jackpot at $100, and we're going to keep the number of tickets sold at 100. What price does the ticket need to be so that the amount collected equals the payout? And with the $100 jackpot and 100 tickets, for the game to be fair, where neither the ticket buyer nor the ticket seller has an edge, the ticket price needs to be $1. If each ticket is $1 and there are 100 tickets sold, the lottery collects $100 and it pays out $100 because that's a jackpot. So that's what the risk and the reward have to be for the lottery to be fair, given those probabilities. As a buyer, your risk is $1 and your profit potential is $99. And your probability of winning is 1%, and your probability of losing is 99%. So we can do this mathematically, right? We can make it simple, right? We just put it in a table, and you get over there on the left side where the probability, you've got your 1% and 99%. And then in the middle, you have your reward and your risk, and your reward is $99 and your risk is -1. Well, you multiply the 1% times the 99 and you get 0.99. You multiply the 99% times $1 and you get minus 0.99. Add them together and it's 0. So for the sum to be 0, where nobody has an advantage, the ticket price must be $1 if the pot is $100 and there are 100 tickets sold. So we know We now know that we can look at the expected probability. That's the ticket sold. We can look at the expected probability and determine the proper risk and reward, and that's the ticket price versus the jackpot. We can also work this in reverse. We can look at probability and get risk and reward, but we can work in reverse. That's where we're going to look at risk and reward, determining probability. So that is, by observing risk and reward, we can determine the expected probability. And that's an important word there, expected. Using our lottery example, and that's by observing the ticket price and the jackpot, you can determine the number of tickets to sell for the game to be fair. So here's the details of the game. Again, it's a simple lottery, and each ticket costs $2. That's the risk. And the winning ticket receives a $100 jackpot. That's the reward. Well, how many tickets need to be sold for the lottery to be fair? That's going backwards, right? And now remember, a fair game is where no one has an advantage. Well, if the jackpot is $100, then the amount collected must be $100 for the game to be fair. And if the jackpot is $100 and each ticket costs $2, then the seller will receive an amount equal to the $100 jackpot when 50 tickets are sold. That means any ticket buyer has a 1 in 50 chance, and the chance of winning is that's a 1 in 50 chance of winning and a 49 in 50 chance of losing. So looked at another way, if the risk is $2 and the profit potential is 98, then the win probability must be 2% and the loss probability must be 98%. So again, we can look at this mathematically. We can just multiply it out. Take the 2% times the $98, 1.96, and we take the 98% times the minus $2, that's minus 196, add them together, and it's 0. So for the sum to be 0, the number of tickets sold must be 50 if the ticket price is $2 and the pot is $100. So here's the key. We can do the same thing with options. Although the process is more complex, the principles are identical. We can look at risk and reward to determine the expected probability. Now think about that. We can look at risk and reward to determine the expected probability. And as we showed earlier, we can measure probability to determine the fair risk and reward. So now we've got an idea that the price, risk and reward is price, we've got an idea that price is and probability are, they are just interwoven completely. But sometimes you get some mispricing, and that's what we're going to talk about next. And this is going to be the source of where we make our money. So I'm going to give you an example of mispriced odds. Now, in the very first example I gave, we use a simple lottery game to demonstrate how you can use probability to determine risk and reward, and how you can use risk and reward to determine probability. At the very beginning, however, we began with an example where the lottery game was unfair. That is, the ticket was mispriced. Well, I want to dive into this idea of mispricing a bit deeper. So let's say there's a game. Let's say there's a game and the expected probability of winning is 10%, which means that the expected probability of losing is 90%. It's not as bad as our lottery examples, but the winning is still a long shot, right? Well, in this example, the expected odds are 1 to 9. That is, for every 10 plays, you expect to win once and you expect to lose 9 times. Because the expected probability is reflected by the risk and reward, we can deduce that the reward must be 9 times higher than the risk. So if this were a real game, it would mean if you risked $100, you would expect to win $900 when you won, but you're only going to win 1 time out of 10. So you play the game 10 times, you lose $100 9 times for a total of $900 in losses, and you win once, you win the $900 1 time. You're even. So you make the $900 and you lose $900 and you're even. The game is fair. But what if the real, this is key, what if the real probability was different from the expected probability? What if we learned that the game's risk and reward were priced for the expected odds of 10%, but the actual probability of winning was 20%? Now remember, the game is priced for an expected win rate of 10%, which means that the risk is $100 and the reward potential is $900. Only the probabilities have changed. The probability of winning improved from the expected win rate of 10% to an actual win rate of 20%. So you play the game 10 times, you lose $100, but you only lose $100 8 times for a total loss of $800 in losses, right? But you win $900 and you win it twice for a total of $1,800 in wins. So that's minus $800 and plus $1,800, which is a profit of $1,000. This is an example of mispriced odds. The cost to play, that is the risk, compared to the amount the winner makes, that is the reward, implies expected odds of 1 to 9. But the actual odds were better, 2 to 8. The cost to play compared to the win amount was too low if the game was supposed to be fair, but the game was not fair. Risk and reward were mispriced based on an inaccurate probability assessment. That's important, the inaccurate probability assessment. The game was priced for an expected win rate of 10%, but the actual win rate was 20%. That inaccurate probability assessment, which consequently led to the mispriced risk and reward, gave one player a built-in advantage. And this demonstrates that if you can spot situations where the probability assessment is inaccurate, that is where the actual odds are better than the expected odds, you too can have that advantage. So that's what we do. This is how we make our money. We identify mispriced odds. So how does one determine probability in options trades? Well, remember that Black-Scholes formula I was talking about? If you look at that N up there, there's an arrows pointing at it up there in the equation up at the top, and N is the cumulative distribution function. So basically what you do, you take that formula, you get the volatility, and you use a couple of fancy formulas, and you get this. And if you look at that red arrow there, you see it says the probability of expiring. So below 113.86, it's about 15.87%. Between 113.86 and 131.05, you get the 68.27. That's basically one standard deviation. And then above 131.05, you get the 15.86. So that's basically telling you what your one standard deviation band is right there. So that's that. If you use this formula and you put some stuff in, you end up with this. So when you make that calculation, the key thing is you're making an implicit assumption, whether you realize it or not. The probability tool assumes an underlier's distribution, and the underlier would be the stock. It assumes the underlier's distribution follows the bell curve. Well, this Fisher-Black, the guy that came up with Black-Scholes, I mean, right? This is the man that came up with Black-Scholes. This is what he wrote about it. This is what he wrote about his own formula. The Black-Scholes formula is still around, even though it depends on at least 10 unrealistic assumptions. That's crazy, but that's what he wrote. Unrealistic assumptions, folks, that's a problem. What if the probability distribution is unrealistic, right? So that would lead to unrealistic probabilities. And because probability is what determines risk and reward, unrealistic probability leads to inaccurate assessment of risk and reward. And because risk and reward are synonymous with price, that means you end up with mispriced options. But there's another way to get probability, and you simply measure what a stock does. And this is what Bloomberg does. This is right out of a Bloomberg terminal. Their function is HRH, the historical return histogram. And this is JP Morgan. This is from a little over a year ago. This is the distribution of JP Morgan shares. And the orange line in the middle, in the chart, in the top chart, the one with the vertical columns and the orange line, the orange line that's the bell curve. And the columns, that's the actual movement of JP Morgan shares. And you can see it's not really following the bell curve. That is, the actual distribution of JP Morgan is a little bit different than what the options market assumes. And you can even see they have a thing there where they talk about just above the columns, they have mean, sigma, and a couple of other things, the chi-squared, and then they have over there to the right, they have something called normality, and it tests the distribution, the histogram, for whether or not it can be accurately represented by the bell curve, and the answer is no. So that's a pretty serious issue that JP Morgan, I mean, if you're using an option pricing model to value an option, you're not going to get you've got a inaccurate probability assessment, right? So here's the thing, that JP Morgan thing, I know how they calculate it, and I can match. In fact, over there on the right, on the left is the JP Morgan, and over there on the right of the Bloomberg, and on there on the right is my spreadsheet, and I can match the Bloomberg's results exactly. And how's that possible? Because I created something like it back in 1996. Now, I showed you what I created in 1993 with the bell curve, and then I showed you the probability cone. Well, in 1996, I was pretty active in this stuff. I created this. It's a spread. This was a spreadsheet back, Microsoft Excel spreadsheet that I created back in May of 1996. And this is the distribution of the S&P 500 going back from 1952 to 1996. So 52 is when they ended the weekend trading. Here's what it looks like today. This is a software program that we've got, and we are about to release it. We use it internally, but we're about to release it to the public at a shockingly low price. We'll have more on that in a little while, but this is Bed Bath & Beyond. So this is the distribution of Bed Bath & Beyond. And you can see there are some tiny columns over there on the extreme left and the extreme right. And I'm measuring these things in standard deviations. And the reason I'm doing that is because I wanted to give you some perspective. So just go back, there's 2 5 standard deviation moves, there's 1 4 standard deviation move, and there's 1 7 standard deviation move. Well, according to Bloomberg, a 5 standard deviation move should happen once every 5,000 years. Once every 5,000 years. Civilization is barely 5,000 years old. And yet it's happened twice with BBBY this year alone. And that's 2 5 standard deviation moves in this year alone. But the 7 standard deviation move, a 7 standard deviation move is even more remote. So we're turning standard deviation into odds. What's the odds of it being outside 1 standard deviation or outside 2 or outside 5 standard deviations? He said that 5 standard deviation move, that should happen once, the bell curve says, it should happen once every 1,744,000 times. The 7 standard deviation move says it should happen once every 390, is that 390 billion? Yeah, 390 billion times. Well, good grief. That's, if it was a daily price, that should happen once every billion years. That's what we talk about when we say it is unrealistic. So this proves that the probability assumption and option pricing formulas provide inaccurate probabilities, which means that certain options may be mispriced. Well, then you're saying, well, okay, that's interesting, Don, but so what? How does all of this help me with my option trades? Because you've covered a lot of territory from lotteries to standard deviations and things like that. But how does it help me with my option trades? Well, if we can spot situations where the actual probability is better than the expected probability, we have a built-in advantage. So now we're going to talk about how to put this into action. It's something that we do. We created software specifically designed to find distorted probability assessments that lead to mispriced options. So this is a screenshot of our odds online, and it gives you an example of what we are looking for in a trade. We have been doing some credit spreads. We've had a lot of success with credit spreads here over the last well over a year. Our system will automatically go out and find these trades. And this one is, we're looking at IWM, which has been one of the things that we've liked to trade. That is the Russell 2000 ETF. And the probability, the bell curve probability, the probability of winning on the bell curve is 90.42%. But the probability of the actual movement of IWM, the measured movement, is 91.12%. So there's a better probability of it winning than the bell curve thinks. And so that's something that we would like to look at. Here's a particular trade right here that the software is suggesting. And the trade is a 1-week trade, and it has a maximum profit of 10.5%. So you put some risk down, and I think the risk is going to be about $180 per spread, and you end up making 10% in a week if you're right. So these are the types of trades we uncover and recommend in our service called Odds High Accuracy. It's where we track, and by the way, with the track record, it's been nothing short of amazing. Here, just going back a year, here are the trades that we've taken, and you can see over there on the far right column, we're making 9%, 8%, 9%, 10%, and so on and so forth. And then we had, back in February of this year, we got out of one at a break even, and then we took a 3.9% loss on the one at the bottom of that. And then let me bring you up to date. We've done some more, and you can see 7.9%. So we're making anywhere between, our target is anywhere from 7 to 11% typically. You know, sometimes we can get more, but it typically 11 to 12% is about as high as it goes. So that's the track record of this thing. And here's the summary statistics. You get if you just added up all the percentages, it'd be 289%. There's 37 trades, 36 winners. So the percentage of trades that make money or broke even was 97%. We're holding these trades for anywhere from 1 to 7 days. And each spread, the average cost is about $276. And one of my employees has a little bit of a perk, right? So Brian, is Michael Bryan, his dad's Mike, and so he goes by the name Brian. Brian, this is from his TD Ameritrade account, and he's doing these things for real, right? So these are real money trades. They're not hypothetical. That track record that I saw you, that's real money. Here's the thing. We are so confident that this recommendation service, which exploits the probability mispricing I demonstrated earlier, we're so confident that it will produce winning trades that we not only profit from the trades ourselves, but we have the most customer-friendly deal in the business. So how does this sound? You pay after the trades close, and only if they are profitable, right? That's what that is. Talk about customer-friendly, that is it. So here's how it works. You go to www.oddshighaccuracy.com/OH. So be sure to use the OH, and you subscribe for $1. You'll get 3 weeks of the service updated daily, and you'll get the recommendations when we find them. Plus, you'll get weekly reports. And afterwards, after the 3 weeks, you continue getting the daily updates and the recommendations and the reports. But after the 3 weeks, you pay only after the recommendations are closed and only if they are profitable. And if you can't make money, we don't make money. It's that simple. We put our money on the line. We take the trades, we do the work, you get our recommendations, and then pay later. But only if the trades make money. It's how you can be guaranteed that we're in this together. So with that, I am finished, and there's the website, www.oddshighAccuracy.com. My name is Don Fishbeck, and I want to thank you for watching, and I'll take any questions if you have anything.
Thank you, Don. That was really informative, and it was really good to see what you've got here in terms of the odds methodology. I mean, I think what you've said here is really, the proof is in the pudding, right?
Yeah.
So we do have a few questions.
It's how we make our money.
Yeah, exactly. So, we're always looking for the mispricing, that edge in the marketplace, and this clearly looks to exploit exactly that. So we do have a couple questions here. One is from Alan. He's asking, what's the cost of payment per trade in the system? So, you mentioned,
Okay,
I guess paying after the trade.
So what we do is we go from one monthly options expiration to the next. So if, let's say we do one, so options expiration is Friday. So if the trades that we have taken from the September options expiration to the October options expiration, if you add up all the percentages and of the trades that we've taken in that time period, if you add them all together and the percentage is profitable, then we will charge your credit card $99. So it's $99 a month when it makes money. And if we don't have any trades during that time period, nobody gets charged. Or if the trades are losing, if there's a loss during the month, a cumulative loss, then we don't charge. But instead of doing it on a per trade basis, we do it on a month to month. And Absolutely. We've had a lot of people that have been, we're not hitting the credit card after every trade is what I'm trying to say.
Yeah, no, that makes a lot of sense. I think that, that's truly putting your money where your mouth is. There's another question here, follow from Alan as well. And he asks how many trades per week. I assume that we would look at per month in this case, as you said that you do this on a monthly basis. So what's your kind of average trades per month?
Yeah, so we've done 37. We did 37 trades in the last year.
Okay.
37 trades and 36 of them were profitable, and one was unprofitable.
Right. So roughly we'll call that pretty close to one per week, with all but one being a profitable trade. So that seems like a pretty good risk reward
I'll tell
ratio.
You the key for us is that we find that there's more mispricing when volatility gets a little bit elevated. So when you get the low, there were some periods during the summer where there was low volatility, and we were kind of cautious about doing some of the trades. And when you get that, we don't want to, the whole point about this is not forcing a trade when conditions, I don't want to promise somebody, I'm going to charge you $50 a month, and I guarantee you're going to get 10 trades this month.
Right.
It's like, well, you know what? It may not be right. So
I think you and I both know you don't want to force a trade just because you said you have to trade. You don't have to trade every day. Cash is a position, right?
That's right. That's right.
No, that's great.
You nailed it.
Another follow-up, are all the trades spreads when you enter them, or do you sometimes do outright options? Okay, all spreads.
No, they're all spreads, because what we're looking for is a high probability, and I'm not a technical trader, not like you are. So I'm going to go on a pure distribution type analysis, a pure, volatility, size, magnitude over time type analysis.
Mhm.
And so to get the high percentages, you need to be selling something. Typically, you need to be selling something. I mean, you can structure some fancy stuff, but typically for most individuals, you need to be selling an option that is out of the money.
Mhm.
And then we never want to do that uncovered.
Absolutely.
So yeah, we turn it into a spread.
Yeah, no, I mean, risk is crucial. For those of you
Hey,
that are
sorry to
still
jump
looking
in
at
here
this, oh,
real
sorry, go
quick,
ahead, Natalie.
guys. I was just going to let you know, I went ahead and used Don's link that he put up, and it takes you to this page. So if you want to click that link, and if you're interested in what Don's talking about, you can get that special option hotline discount. This is what the
That's
page
right.
looks like. Yeah, and we'll go ahead and send that out to all of y'all tomorrow with the replay information and the freebie and things like that. But just having it up here, let's let you jump back in, Keith. Thanks.
Absolutely. Yeah, no, thank you for, I was about to say the same, Natalie, so I appreciate you jumping in though. So yeah, no, I
Was
mean, I
that
definitely,
Natalie?
yeah, that was Natalie. So yeah, this looks like a great
All right.
opportunity. I mean, especially with just
Hey,
a dollar
Don.
due today. So
Hello.
I urge you all to take a look at this link and see what you think. You can see what the customers say and everything else to evaluate your decision on this. And then I think we have one final question here, Don. And the question is basically, we sort of started with this idea of the October options marketplace. Is there anything that you guys are seeing today, any trends that you're recognizing today in the marketplace and maybe unique from what we had seen from prior months?
The biggest, I'll tell you what the biggest thing is. And so we also have, we do more. I'm not a one trick pony. I do more than just the high accuracy credit spreads. One of the things that we do some market timing. And for all the people that say, well, you can't do market timing, we have in our trading, and we have statements to back it up. We've beaten the S&P 500, and only about 90% of the folks underperform the market, and only about 10%, and these are the professionals, only about 10% actually beat the S&P 500 over a 10-year period. Well, we've beaten the S&P 500, and I mean by large margin. We beat them over 1 month, 3 month, 1 year, 3 year, 5 year, 10-year period. And looking at a 10-year period, I think the S&P 500 total returns up about 350%, and our portfolio is up about 685%. So we've beaten it by a very wide margin. And we use a series of 3 indicators to give us the guidance. And one of those turned bearish in the middle of September. It's a behavioral type of indicator. It's using sentiment to tell us that we should be cautious. And what's basically happened, and Keith, what we see, and I don't know, there may be some disagreement with other people, but we see that buy the dip has turned into sell the rally. That where basically since April 2020, you've had any kind of dip, people have come in and bought it. Any kind of dip, people have come in and bought it. Well, now we're seeing any kind of rally, people are selling it. Any kind of rally, people are selling it. So that is, to me, and that could change it could change tomorrow, right? But that's what we're seeing is sell the rally. I'm going to throw one other thing out, and I've been following the NASDAQ index, and I don't know if I was in the business back in 1987. I was a broker back in 1987, and if you match up the NASDAQ peak back in August to the NASDAQ peak in 1987, the pattern since the August peak is disturbingly similar. And I'm just really, really nervous about it. And we've seen this change in behavior. And so there's just a lot of things that are a little bit too similar to 1987 for my taste. And anyway, that's kind of what I see over the next few weeks. I'll tell you this: if my indicators change, I'll flip flop in an instant. But as of right now, I'm a pretty nervous Nelly.
No, I understand that entirely. I think a lot of the marketplace seems to be a bit nervous. I mean, there is one final question here we had just regarding the operational aspect of the program. So if someone determined that they were just, this isn't for them, is it easy to handle a cancellation? Is that just an email to you, or I assume?
Yeah, they just
Yeah.
Cancel anytime.
Yeah, no, I kind of assume, but yeah, that's always important that people know their entry and their exit on these sort of programs as well as the
Hey,
market
let me
itself.
tell you, I'll tell you this, because we charge after the trades are closed. So we would take the, October Friday is where we will do the measuring period, and we actually charge the cards on the subscribers Monday morning. If somebody cancels, let's say it's profitable from September until October, which it is. Let's say it's profitable. Well, we don't know because I don't know the outcome of the trade we're in right now.
2 days.
Yeah. So, but let's say it's profitable. If they cancel Friday, they've gotten a month's worth of service. I shouldn't tell them this, but they've gotten a month's worth of service, and then they cancel on Friday. We don't charge them Monday.
Oh.
So,
there's an arbitrage for you, but just be aware that if you do that, you're not going to get those future winners. So
that's the issue, and we won't forget who you are.
Right. So I recommend not necessarily taking advantage of that little arbitrage, but teach their own. It sounds like there's a great opportunity here to try it out for a very low price, and then try it out for literally free. If it doesn't work out, you don't have to pay. Thanks again, Don. All of this has been amazing. We look forward to having you on again. If there are other questions, feel free to email us, support@optionhotline.com. And definitely be on the lookout for an email from webinars@optionhotline.com with the replay and another link to Don's amazing offer here. So again, Don, I really appreciate your time, and I hope everybody is looking forward to our next Option Hotline webinar coming up in a few weeks.
Bye now.